Silicon Valley Bank, lender to some of the biggest names in the tech industry, collapsed on Friday, the largest bank failure since the 2008 financial crisis, forcing regulators to move quickly to avert a meltdown, as the bank's collapse reverberated across global markets.
At least so far, this is not 2008.
Alexander Yoakum, an equity research analyst at CFRA Research, explains.
Silicon Valley Bank is a little bit different than most banks, right? So they cater to venture capitalists and private equity firms. Because last year and this year, funding has really fallen off a cliff. Now some customers want some money, and they don't have the deposits to give them back.
California banking regulators shut down the bank and put it under the control of the Federal Deposit Insurance Corporation. The FDIC said the main office and all branches of Silicon Valley Bank will reopen on March 13th, and that all insured depositors will have full access to their insured deposits no later than Monday morning. Dean Nelson, CEO of startup Cato Digital, said he had accounts with SVB.
Yeah, this morning I came out to talk to the bank, just got in line with a lot of other founders and, and CEOs, just to find out what's happening and then also the options we've got. And really as a CEO, we have to make sure that both our employees, our customers, and our investors, we're protecting the things that we have. So that's what we're looking to explore. But they just came out and told us that the bank is shut down. I think they're just trying to figure out everything that they can by Monday. A little nerve-wracking when it comes down to how you keep operating your company.
In a memo to employees Friday morning seen by Reuters, SVB said it was undergoing a series of conversations to determine next steps.
Companies listed in London, Paris, Amsterdam, or elsewhere on the continent trade with a giant valuation discount to those listed in the US. In fact, the gap is about as big as it's been in recent history, but it doesn't apply across the board. Tech and healthcare stocks, for example, appear to have a roughly similar valuation multiple either side of the Atlantic. And if you zoom in on the sector that seems to have the biggest discount, which is called consumer discretionary, you notice that the companies are actually starkly different. The US sector includes Amazon.com and Tesla, whereas the Europeans includes carmaker BMW and the luxury group LVMH. Perhaps unsurprisingly, the American pair are growing a lot quicker than the Europeans. That faster rate of growth justifies a much higher valuation, no matter where you're listed. It's the same in the other sectors that have a big transatlantic valuation gap. Across energy, financials, consumer discretionary, and frankly most other areas of the economy, the US listed companies simply grow faster. You can actually adjust the valuations for that using something called the PEG ratio. It's not a very precise tool, and there are much more sophisticated ways of doing it, but the results are still illustrative. If you adjust for those growth differentials, you can see that the valuation gap pretty much disappears and even reverses in the case of the UK stocks. In other words, what appears to be a difference of listing location is really a difference of business dynamism. UK and Eurozone stocks do indeed have lower valuations at first blush, but it's mostly deserved.
The Ariya was going to drive Nissan's comeback charge in electric vehicles, but it turns out problems have hit its expensive high-tech production line and slowed delivery of the car. That's according to 4 sources close to the matter. The Ariya was unveiled 3 years ago to strong reviews and was Nissan's first all-new global car in 5 years, but the sources say production is running at least a third below plan. That has kept the Ariya from being shipped to new customers. 2 sources said production faced problems with the highly automated intelligent factory manufacturing system at one of its plants in Japan. The intelligent factory Ariya line was built with an initial investment of $243 million. The system is supposed to allow Nissan to produce cars with different powertrains on the same line. One source said implementation had proven an extremely high challenge. In a statement, Nissan said Ariya production had faced challenges. It included semiconductor supply shortages, disruptions in component shipments, and the factory's paint line. Nissan said it was working to fully regain production capacity at the plant. Now, analysts say the shortfall is a lost chance to build on the positivity around the Ariya. It was due to test demand for the first of 19 new EVs Nissan plans to roll out by 2030. The setbacks have also hurt the Japanese automaker's plans for growth in electric car sales. Nissan was an early pioneer in the EV market before Tesla raced ahead and dominated the sector.